Hey there, future millionaires. Ever wonder how the super rich get so wealthy? It's not just about earning a big salary, it's about making their money work hard for them. They understand the power of investing, especially in the stock market. Think of it like owning a piece of a successful business. That's what stocks are. And when those businesses grow, so does your money. It's like planting a seed that grows into a money tree. We're going to break down everything you need to know about stocks, from what they are to how they can help you achieve your financial dreams. Get ready to unlock the secret weapon of the wealthy. Let's get down to basics. Stocks. What are they? Imagine your favorite company like Apple. When you buy stock in Apple, you're buying a tiny piece of ownership in the company. You become a shareholder. These shares are traded on the stock market, kind of like a giant auction. As the company performs well, demand for its stock goes up and so does the price. That's how you make money. Think about Tesla. A few years ago their stock was much cheaper. Now look at them, or Amazon. They started small, but investors who believed in their vision and held onto their stock are reaping huge rewards today. You could be one of them. Now you might be thinking, why not just keep my money in a savings account? Well, here's the thing. Savings accounts offer tiny interest rates, barely enough to keep up with inflation. Your money is practically asleep. Stocks, on the other hand, have historically delivered much higher returns. Over the long term, the stock market has averaged around 10% annual growth. That's a huge difference. While other investments like bonds or real estate have their place, stocks offer the potential for faster growth. It's like choosing between a leisurely stroll and a rocket ship to financial freedom. Which one would you pick? Here's the really exciting part: compound growth. It's a concept that has the potential to transform your financial future in ways you might not have imagined. Einstein called it the eighth wonder of the world, and for good reason. He understood that compound growth is not just a mathematical curiosity, but a powerful financial principle. When you reinvest your earnings, your money starts making more money. This means that the interest or returns you earn also start earning returns. And then that money makes even more money. This cycle continues, creating a snowball effect where your wealth grows exponentially over time. It's like a snowball rolling downhill, getting bigger and bigger. The initial growth might seem slow, but as time goes on, the growth accelerates. The longer you invest, the more powerful this effect becomes. Just like a plant that grows stronger and taller over time, your investments can flourish if given enough time. That's why starting early is crucial. The earlier you begin, the more time your money has to grow and compound. Even small amounts can turn into substantial sums if invested wisely over a long period. Let's say you invest $1,000 and earn a 10% return. This might not seem like much at first, but let's break it down. Next year you have $1,100. That extra $100 is your earnings from the first year. But here's the magic. The following year, you earn 10% on $1,100, not just the original $1,000. This means your earnings are now working for you, generating even more returns. Over time, those gains snowball into significant wealth. The key is patience and consistency. By staying invested and allowing your money to compound, you can achieve financial goals that might seem out of reach today. So start now, stay committed, and let the power of compound growth work its magic for you. Section 5. Beating inflation. How stocks keep you ahead. Remember inflation? That sneaky villain that makes your money worth less over time? Well, stocks can help you fight back. As prices rise, companies often increase their prices too, which can lead to higher profits and, you guessed it, higher stock prices. While past performance isn't a guarantee of future results, historically, stocks have outpaced inflation, helping investors protect and grow their purchasing power. It's like having a superhero shield against the eroding effects of rising prices. Section 6. Your first stock opening a brokerage account. Ready to dive in? The first step is super easy: open a brokerage account. This is like your gateway to the stock market. There are tons of great options out there like Robinhood, Fidelity, and Charles Schwab. These platforms are user-friendly, even for beginners. They offer educational resources, research tools, and even fractional shares, so you can invest in expensive stocks with just a small amount of money. Don't be intimidated. It's like signing up for any online service. Once you've chosen your platform, just follow their simple instructions to open your account and get ready to start investing. Section 7. Building a winning portfolio: index funds and ETFs. Now, choosing your investments is a crucial step in your financial journey. It can seem daunting, but it doesn't have to be. Don't worry, you don't need to be a Wall Street whiz to pick winners. With the right approach, anyone can build a solid portfolio. A great strategy for beginners is investing in index funds or ETFs. These investment vehicles are designed to be simple and effective. Think of an index fund like a basket of stocks that track a specific market index, like the S&P 500. This means your investment is spread across many companies, reducing risk. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of the 500 largest companies in the US. This gives you instant diversification, which is key to managing risk. ETFs, or exchange-traded funds, are similar to index funds but with a few differences. They trade on an exchange like a stock, which means you can buy and sell them throughout the trading day. They offer diversification and can track specific sectors like technology or healthcare. This allows you to target particular areas of the market that you believe will perform well. It's a smart and simple way to spread your risk and potentially maximize your returns. By investing in a variety of assets, you can protect yourself against the volatility of individual stocks. Over the long term, both index funds and ETFs have shown to be effective tools for building wealth. They offer a low-cost, low-maintenance way to invest in the stock market. Remember, the key to successful investing is patience and consistency. By regularly contributing to your index funds or ETFs, you can take advantage of compound interest and grow your wealth over time. So, whether you're just starting out or looking to diversify your existing portfolio, consider index funds and ETFs as a cornerstone of your investment strategy. They offer a balanced approach to investing that can help you achieve your financial goals. Section 8. Time in the market beats timing the market. Here's a golden rule. It's not about timing the market, it's about time in the market. Trying to predict when to buy low and sell high is incredibly difficult, even for the pros. Instead of stressing about short-term fluctuations, focus on the long game. Invest consistently, even if it's just a small amount each month. This is called dollar-cost averaging, and it helps you buy more shares when prices are low and fewer shares when prices are high, averaging out your costs over time. Remember that snowball effect? The earlier you start investing, the more time your money has to compound and grow exponentially. Section 9. Common pitfalls and your path to financial freedom. Now, even though investing in stocks is a fantastic way to build wealth, there are a few common mistakes to avoid. Many new investors get excited by the potential for high returns and jump in without a solid plan. This can lead to costly errors that could have been easily avoided with a bit of knowledge and preparation. First, don't put all your eggs in one basket. Diversify. This means spreading your investments across different asset classes, industries, and even geographical regions. By doing so, you reduce the risk of losing everything if one particular investment doesn't perform well. Diversification is a key principle in risk management and can help smooth out the ups and downs of the market. Second, don't panic sell when the market dips. Market downturns are inevitable, and they can be unsettling. However, selling off your investments in a panic can lock in losses and prevent you from benefiting from the market's eventual recovery. Instead, stay calm and remember that market fluctuations are a normal part of investing. Remember, investing is a marathon, not a sprint. Short-term fluctuations are normal. It's important to keep a long-term perspective and not get too caught up in the day-to-day movements of the market. Over time, the market has historically trended upwards, rewarding those who stay the course. Stay focused on your long-term goals. Finally, avoid emotional investing. Making decisions based on fear or greed can lead to poor investment choices. Instead, base your decisions on research and a well-thought-out strategy. Don't let fear or greed dictate your decisions. Emotional reactions can cloud your judgment and lead to impulsive actions that may not be in your best interest. Stick to your plan and stay disciplined. Do your research, invest in what you understand, and stay disciplined. Knowledge is power in the world of investing. Take the time to learn about the companies and assets you're investing in, and don't be afraid to seek advice from financial professionals. The journey to financial freedom starts with a single step. It might seem daunting at first, but every small action you take brings you closer to your financial goals. Whether it's setting up a savings plan, opening an investment account, or simply educating yourself about personal finance, each step is a move in the right direction. Open that brokerage account today, start investing, even if it's just a small amount, and watch your money grow. You've got this. Remember, the key to financial freedom is consistency and patience. Stay committed to your plan, keep learning, and don't be afraid to seek help when needed. Your future self will thank you for the steps you take today.